Welcome to the July edition of the Market Update. My name is David Hobbs with Cedar Wealth. I do want to apologize for the audio. I've had some issues with my screen recording software, and instead of delaying this a couple more days, just wanted to get this out just as soon as I possibly can. So in this update, I really want to talk about what's happening in the current bear market, as well as be able to answer some basic questions I keep getting from different clients. And the biggest one is really asking, why is the market down? And the reality is that the first half of 2022 saw the S&P 500 decline 19.98% from the high of 4,700 to 3,700 as of June 30th. Now, personally, I hate it when the market declines. It's disappointing and truly depressing at times to see these prices decline. Now, bear markets like we've seen, and bear markets like we're in now, and recessions like we may enter into, are certainly painful. However, what I always do want to remind people, these are regular parts of investing. And if they never occurred, the reality is that far more people would own stocks, which would most likely result in continually high market prices and I would assume rather low returns. However, when we think about the S&P 500 and we think about it being down about 20%, remember there's 505 companies that represent the S&P 500. And that S&P 500 loss is again about 20%. So the question is, do you really think that these 505 companies have lost about 20% of their value for the rest of time? For me, I certainly do not believe that. Now, using history as a guide, the single best way to destroy your investment success has been to sell out of equity portfolios when we're in a bear market. And a historical example on this would be to buy the market peak before the financial recession of 2008. And so what you're seeing on this chart here, let me get myself out of the way, is looking at from January 1, 2008 to June 30th, last month. And what I really want to point out here is that the annualized return of the S&P 500 is still 8.88% over this period of time. Now, keep in mind that during this time period, the market dropped over 50% during the financial recession, then dropped close to 20% a few more times, then dropped over 30% because of COVID, and now it's down about 20%. Now, what's more, if you sold your portfolio at the end of 2021, which is not shown here, but if you sold your portfolio at the end of 2021 versus holding until the end of June, your annual return from 2008 to the beginning of 2022 would be 10.96%. Now, with that said, a question that I want to pose to you is, do you really believe the world is going to end or the markets won't ever recover? Personally, I believe the markets will do what they've done over the past 100 years and recover. So with that as an introduction, let me attempt to answer the most common question I've received this past month, and that is, why is the market down? And put simply, it's because of interest rates and inflation. But let me get more granular on this. In years 2019 to 2021, the S&P 500 returned about 25.9% annually. And this does include the COVID-19 drop. Now, but when inflation started to rise in late 2021, it became evident the gains in the prior years had been fueled, at least in some extent, to too much money sloshing around in the economy. Now, the Fed, in my opinion, I feel is late in addressing the inflation problem and is attempting to take out some of this excess dollars in the economy by increasing interest rates and shrinking their balance sheet. So a good example on this is, let's say, for example, someone offers to give you $100 today or maybe $100 in a year. Now, the question for you would be, what's more valuable for you, $100 today or $100 in a year? Well, of course, the $100 today is more valuable because the 100 in a year won't be able to buy the same $100 of goods. Well, the same idea works when we think of valuing companies. If we buy part of a company, a stock, what we're really looking to buy is future cash flow from that company, right? So when inflation is low and a company kicks off $100 a year, that company is more valuable than when inflation is high and kicking off $100 a year in the future. And this idea is one of the main reasons the market is off from higher values. Now, another type of question I'm getting is, could this decline have been avoided? And this is really the most common follow-up question. Personally, using history as a guide, I feel the best time to invest in money is when you have it. No one can forecast the future. And yes, I've realized the famed Michael Burry of the Big Short is calling for the next major recession. Now, I personally have no way of knowing if he's going to be right or wrong, but I do know this isn't the first time he's been calling for a major recession. And according to American funds here, if every year you say there's going to be a 15% plus decline, you'd be right every 3 to 4 years, as you can see here. So I also know that over the past 100 years, the market has returned about 10.45% with dividends reinvested annually. And it'd be difficult for someone to achieve those returns without simply staying invested. And so, the next question on this is, how does inflation cool off? Well, the bad news with inflation is that it does have to run its course. The cure to high prices are, unfortunately, just high prices. And high prices have historically curbed consumer demand because they simply can't buy as much. It makes sense. And so, 2 years post the COVID-19 decline of 2020, the American consumer is still flush with cash. And, when people say, well, what's your guess on inflation? Well, my personal guess is that on July 13th, when the Fed meets again, we're going to get the inflation report from June. So you can see this chart. And we'll start to see some cooling off in inflation. That's my guess. And this is one chart, as I'm sharing on your screen now, that I regularly review. It's M2. And M2 is really broadly defined as the amount of money in circulation. And this is a report from the Federal Reserve. Now, keep in mind, this report was last updated in May of 2022. This should be updated in about a week and a half or so. But what I'm hoping for is be able to see this continuing slowing tail off. Right down here is what we're seeing. Each month I get asked by different clients what additional resources I would encourage reading. And this month I have 3. Now, please hear me in stating I'm not trying to predict anything whatsoever, just some data that I'm watching. Something that I find is interesting is, of course, with the current sell-off in Bitcoin, I have gotten questions over if people should be buying in. My personal view, and I've written about this and spoken about this before, I have trouble valuing Bitcoin. This is an excerpt written by an economist I follow, Scott Granis. I highlighted a comment here. Bitcoin is the very definition of a speculative asset. You can read the entire posting. Another data point is what happens historically as the market is down. So I am going to pause on this chart for a little bit here because there's a lot going on. What this is showing is that what happens when there's a 15% or more decline in a quarter, right? From 1950 to current. And so you can see there are 1, 2, 3, 4, 5, 6, 7 different occurrences where there's been a decline of 15% or more over a given quarter. And so what we're seeing now, right? We have some precedent of this in the past history. And so when we have these significant declines, 1 quarter later, here are the returns, and here's the average, 6.8 positive. 2 quarters later, we have a positive 17. 4 quarters later, a positive close to 30. We, of course, have no way of knowing if this is going to continue in the future or not. But this is a great data point to be able to look at what's happened historically. Now, the third and final item is looking at PE ratios. Now, looking at PE ratios, and I looked at this last month as well, and the PE ratio chart here from JP Morgan. Here we go. Last month, this ending point was roughly here, about 17, high 17s, I believe is what it was last month. Now we're at 16, which most notably is below the 25-year moving average. So again, I'm not trying to predict anything, but this is simply a data point that I do want people to be aware of. Now, something that I shared last month, and I think it's prudent to share again this month, is just looking at different market truths. And these are items that I hold to, and I would encourage every client that I work with to be able to hold on to these as well. And that the stock market cannot be consistently timed. The economy, as you define it, cannot consistently be known or timed. Over the past 100 years, the market's returned 10.45%. The average intra-year decline is about 14%. And investing in equities has historically been volatile. You can read more there. Now, with that, I certainly want to thank you for tuning in for this month's market update. As always, if you have any questions whatsoever, do not hesitate to reach out to me directly. There's always a link to be able to schedule on my calendar. And as always, thank you for your trust. Should you have any questions, please reach out. Thank you.